Welcome back to the Market Podcast. Asymmetric info for individual investors. Educational info only, not financial or legal advice. Consult a pro before investing.
Imagine a future where cutting-edge medical imaging, the kind traditionally locked away in huge hospital systems with massive costs, shrinks right down. Picture it the size of your smartphone, accessible pretty much anywhere.
It's a powerful image.
And then picture this nimble innovator taking on an established giant, one that's dominated healthcare for decades. But here's where it gets really intriguing. What if the leaders of this disruptive company, the ones with the deepest insight, are quietly signaling their own reservations through their personal financial actions?
That's the core question we need to unpack.
We're going to explore what these insider moves might really mean for the long-term potential of this healthcare transformation. We'll start by looking into the company's leadership. It's a blend of, seasoned medical technology veterans and some truly visionary innovators.
Absolutely.
We need to uncover not just their professional expertise, but also those subtle yet incredibly significant signals their personal financial decisions might be sending.
It's critical for any individual investor to understand the people steering the ship, especially when they're aiming so high.
Right.
And this leadership team is a remarkable mix of deep experience and, let's say, forward-thinking vision. However, when you really drill down into recent insider stock sales, it adds this layer of complexity. You start to question their absolute confidence in this monumental task, challenging GE Healthcare's dominance in that massive $80 billion global ultrasound market.
So let's start at the top. The CEO, Joseph DeVivo.
Yes, DeVivo. He joined in 2021, and his background is genuinely impressive. Before this, he led AngioDynamics through a significant turnaround, actually doubled its revenue through smart acquisitions and product expansions.
So he knows how to scale medical device companies.
Exactly. That's his expertise. And we saw it quite clearly with the accelerated launch of their IQ3 probe in 2024. That single move demonstrably boosted U.S. sales up 24% in the first quarter of 2025, hitting $16.6 million.
And that IQ3 directly targets GE's territory, right?
Right.
The traditional high-cost portables.
Precisely. It's aimed squarely at that legacy market.
Okay, so he's got the track record. The IQ3 launch looks strong, but then there's this financial move. It seems, a bit contradictory to that bold vision.
Exactly. This is where things get a bit unsettling for investors. Joseph DeVivo sold shares worth around $781,000. This was back in May 2025 at about $2.44 per share.
Nearly $800,000.
It's a significant amount. And despite his very public, bold vision for democratizing ultrasound, it really makes you wonder, is he hedging his personal bets? Given the ongoing company losses and the really fierce competition from GE's own V-Skin handheld line.
It certainly raises questions. What about the CFO, Heather Getz?
Heather Getz. Her background includes a strong period of biotelemetry, focusing on financial restructuring. She was key in optimizing costs during their high growth phases. That company was later acquired for $2.8 billion.
So she knows financial discipline during growth?
She does. And here she's directly led significant expense reductions. They cut operating costs by 3% in Q1 2025, even while revenue grew 20%. That provides absolutely crucial fiscal discipline, which is vital when you're going head-to-head with a behemoth like GE that operates on such an immense scale.
Sounds like exactly the kind of CFO a high-growth, cash-burning company needs. Yet her actions seem to mirror the CEO's caution.
They do echo it. She also sold shares about $144,100 worth, also in May 2025. Her move parallels the CEO's, and it could indeed signal some internal doubts about hitting near-term profitability, especially in a market where GE commands a truly significant 38% share. It's a consistent pattern we're seeing.
Okay, CEO, CFO. Then there's the founder, Jonathan Rothberg. He's also the board chair.
Right, Rothberg, a true serial disruptor. He's renowned for pioneering next-gen DNA sequencing at Ion Torrent. That company was acquired for $725 million. His ongoing involvement profoundly shapes this company's chip-based technology strategy.
Especially the AI integration. It's exactly. Integrating artificial intelligence for faster diagnostics. And that approach, if it scales effectively, really does have the potential to significantly erode GE's traditional market position over time.
He's the visionary spark, then. But even with that deep involvement, that founder status, is he showing unwavering faith financially?
Well, despite his visionary role and that remarkable track record, we've observed pretty limited recent buying activity from him. Now, he still holds a substantial amount, 33 million shares as of June 2025.
That's significant.
It is. But when you place it against the backdrop of overall net insider selling trends, it does raise a crucial question about that unwavering personal faith and the long-term competitive struggle, especially when other key executives are actively selling stock. And Rothberg, remember, he's been deeply involved since 2011. He infuses the organization with that sort of genius flair for biotech disruption.
The napkin sketch story. Exactly, the famous anecdote sketching the ultrasound on chip idea on a napkin. It directly mirrors his prior DNA sequencing breakthroughs. And that core idea now drives products like the IQ3, specifically designed to challenge GE's bulky systems right at the point of care. The company benefits immensely from his talent and his track record of building billion-dollar exits. It really positions them as a founder-led outlier.
And founder-led companies often outperform?
Historically, yes. They tend to deliver about 3 times the returns of non-founder-led peers, largely due to that deeply aligned long-term vision. His large holding, plus executive incentives tied to equity, certainly signals strong alignment with investors, at least on paper.
A powerful narrative. But then the contradiction, the vision versus the actions.
A stark contradiction. Despite this compelling story, we saw a net selling of $922,000 in the second quarter of 2025 by key executives.
Nearly $1 million just in Q2.
Yes. It suggests a potential divergence from that outperform thesis. They're burning significant cash, competing with GE's huge economies of scale. And this pattern of executive share disposals, without major buys from the founder to offset it, could certainly undermine confidence in their ability to sustain this portable ultrasound revolution against GE's resources.
Which brings us right to the company's core purpose. Its mission, its vision, its culture. What are they fundamentally trying to achieve?
Their mission is remarkably clear and ambitious. Democratize medical imaging. Make ultrasound accessible everywhere, almost like a modern stethoscope.
Taking it out of just the specialist's hands.
Precisely. They're explicitly aiming to expand that $8 billion point-of-care ultrasound, or POCUS, segment within the much larger $80 billion total ultrasound market. Their whole approach empowers non-specialists, particularly in remote or underserved areas. That's a direct contrast to GE's traditional focus on premium, hospital-centric machines.
And their vision extends beyond just the clinic.
It does. Their leadership's vision, laid out in their roadmaps, includes AI-driven home care and global expansion by 2026. Products like the IQ3 are integrating advanced AI tools like MSK-VUE for real-time musculoskeletal guidance. This strategy could significantly disrupt GE's 38% market share by dramatically lowering the barriers to access.
You mentioned the example of a rural doctor.
Right. Imagine a doctor in rural Kenya using one of these compact devices for obstetric scans. They have partnerships like AmPath facilitating this. It could potentially save countless lives where GE's $50,000 plus systems are simply impractical or unaffordable. That's the real-world impact they're aiming for.
It's a deeply impactful vision. What about the culture needed to support something so revolutionary?
Culturally, they foster a very explicit, innovation-aligned ethos. You see cross-functional teams emphasizing rapid iteration, constant feedback from clinicians. Their 360-degree education platform is a great example. It's trained over 145,000 users worldwide.
That internal alignment is crucial.
It is. But again, that persistent pattern of executive share disposals, even during a strong quarter with 20% growth, subtly hints at potential internal doubts. Doubts about the cultural resilience needed to really withstand GE's resource-backed countermoves, like the competitive pricing on GE's Vscan Air. It's a quiet challenge to the narrative of unwavering internal confidence.
So how do they actually make this happen? Let's get into the mechanics. How does this company operate, turning something so complex into something simple and accessible?
The core operations are actually quite straightforward to grasp, even if you're not in the medical field. Imagine taking a traditional ultrasound machine, those big, room-filling GE carts costing tens of thousands, and shrinking it down into a handheld probe that just plugs into a smartphone.
The magic is in the chip?
Exactly. It's achieved by using semiconductor chips instead of bulky piezoelectric crystals. That makes diagnostics both truly portable and remarkably affordable, typically around $2,000 per unit. Simply put, it's like turning your phone into a full-body scanner for quick checks. In emergency rooms, remote clinics. It truly democratizes what was once specialist-only tech.
Are there hidden complexities?
Well, there are subtle ones. The proprietary ultrasound on chip, integrating with advanced AI algorithms for image processing, plus the recurring subscriptions, that's about 20% of revenue now. But these nuances are kind of like how Tesla's software updates enhance their cards after purchase. They add value over time.
And the revenue breakdown.
It's important to remember hardware sales currently drive 80% of revenue. Software adds that crucial layer of predictability. This whole model strategically positions them against GE's legacy systems.
But the insider selling suggests lingering doubts about scale.
It does, particularly after the successful IQ3 launch. It suggests even leaders might question if this elegant simplicity can scale fast enough to really erode GE's dominance without needing even deeper capital expenditures down the line.
So what are the specific products and services driving this unique model forward right now?
The flagship is definitely the IQ3 probe, launched in 2024. It's a whole-body ultrasound device packed with significant AI enhancements.
Like the lung assessment feature.
Right. Features like the auto beeline counter for precise lung assessments and MSK-VUE for real-time musculoskeletal guidance. This device has clearly found strong product-market fit in POC US. You see it in the numbers. Over 145,000 global users, 20% revenue growth in Q1 2025, reaching $21.2 million. That's a big leap from their initial niche adoption in medical schools, where they now have over 155 partnerships.
And it addresses pain points GE overlooks.
Absolutely. Primarily affordability, which is crucial for emerging markets. Units sold were up 15% year over year. Their roadmap eyes home care expansions by 2026, integrating more AI partners. They had 23 as of Q1, and workflow tools like dissects.
The processing speed is also key, right?
Critically important, the IQ3 is twice as fast as its predecessors, which significantly impacts adoption. Think of Dr. Haney Melamat, a critical care physician, using it for immediate bedside diagnostics without delays. That's powerful. And while there aren't unique financial products per se, those subscriptions, the education suites, for example, make up 20% of revenue. That helps stabilize the stream.
So it's positioned to challenge GE incrementally.
Yes, incrementally. But those executive share disposals, totaling $760,000 in Q2, suggest lingering concerns. Concerns about its fit in those high-stakes hospital deals where GE's reputation for reliability and comprehensive service often wins, even against a potentially better, cheaper technology.
This really does sound unique. Can you just crystallize what specifically sets this company apart, especially from a giant like GE?
What truly distinguishes them is their laser focus on what some call the hedgehog principle, becoming world best at one specific thing: chip-based portability, operating as an economic engine fueled by recurring software revenue, and having a profound passion for global access.
10 times cheaper, you said.
Their chip-based tech makes their devices roughly 10 times cheaper and far more efficient than GE's traditional piezoelectric technology. It's a fundamental difference.
And the flywheel model.
Right. The business model acts like a flywheel. Sell probes affordably, hook users with essential AI subscriptions, then gather anonymized data to continuously refine the algorithms it feeds itself.
The Kenya example illustrates the impact.
Perfectly. The AMPath case in Kenya, where the devices trained diverse clinicians on complex scans like cardiopulmonary that builds loyalty, GE struggles to match with its expensive equipment. This uniqueness creates a powerful narrative of disruption, much like how Uber disrupted taxis.
But against GE's scale.
Exactly. Against GE's sheer scale, executive sentiment expressed through their holdings and selling patterns becomes a critical indicator. That recent pattern of executive share disposals suggests that while the model is unique, the engine might not be spinning fast enough yet to sustain the necessary internal confidence against GE's overwhelming competitive pressures.
Let's look at the journey so far. What's the track record that brought them here? Key milestones.
The journey from founding in 2011 to the 2021 public offering, where the share price peaked around $15, includes some very significant milestones. Initial product clearance in 2018 was huge. Then the pivot during COVID to Ultrasound, which actually boosted 2020 sales by 50%.
And the IQ3 launch more recently.
Yes, the 2024 IQ3 launch drove that remarkable 35% growth in Q4 2024. Their strategic reinventions are also notable, shifting from a consumer focus to clinical after the post-public offering slump, integrating AI effectively amid the POC US boom that yielded consistent 25% annual revenue growth, hitting $75 million in 2024.
Any specific quantitative wins?
Market share in handheld devices grew from almost nothing to 0.16%, and they secured $175 million in cash after that $82 million capital raise in Q1 2025. Rothberg's own pivot from DNA sequencing to ultrasound mirrors market shifts to portable tech, showing impressive adaptability.
So a credible track record, adaptability shown. But again, are these successes enough to fully offset those cautionary signals?
The track record definitely builds credibility for their challenge against GE, no question. However, that recurring pattern of executive share disposals, especially right after these growth spikes like the CEO selling in May, does temper the success story. It hints at potential limits to their adaptation, especially within a healthcare sector often prone to economic downturns. It suggests even strong growth might not be enough to convince those closest to the operations.
How do they manage global operations with this lean structure? Where are they based?
They're headquartered in Burlington, Massachusetts. R&D is in Guilford, Connecticut. That's where the chip design and AI development happens. But they operate globally through sales hubs in over 30 countries, importantly including emerging markets in Africa and Asia. They have partnerships, like in Kenya, for training.
And they keep it lean by leasing and outsourcing.
Exactly. They lease facilities for flexibility. They don't own them. Chip manufacturing is strategically outsourced to Taiwan Semiconductor Manufacturing Company, TSMC. That gives them cost efficiency and access to cutting-edge tech. Software development is also outsourced to a network of 23 AI firms.
More agile than GE, but more vulnerable.
That's the trade-off. This lean structure provides significant agility compared to GE's integrated factories, but it absolutely creates vulnerabilities. Global trade tensions, especially U.S.-China relations over critical chips. That's a big one. It's possible the executive share disposals reflect an awareness of these specific supply chain risks.
And related to that, how vertically integrated are they? Do they control the whole production process?
They have remarkably low vertical integration. They completely outsource chip production to TSMC and manage distribution through partners. This strategy dramatically slashes costs, hence the impressive 63% gross margins in Q1 2025, up 4.8 points year over year. It also enables incredibly quick iterations.
So AI upgrades don't require retooling factories.
Precisely. AI upgrades for the IQ3 can be rolled out without needing in-house fabrication. It's a stark contrast to GE's highly integrated model, which ensures reliability but also inflates prices. This company's approach boosts efficiency. Unit costs are down 10–20% year over year and enhances customer experience via faster updates.
But the downside is lack of control.
Yes, that lack of direct control exposes them to potential disruptions. Supply chain hiccups could erode their competitive position, and that pattern of executive share disposals might very well signal that this low vertical integration is seen internally as a significant weak point in the long-term fight against GE.
How do they actually get these innovative products to the users? What's the distribution strategy?
They use a clever hybrid distribution model. Part of it is direct-to-consumer online sales for probes like the $2,000 IQ3, often bundled with subscriptions.
And the other part?
Business-to-business partnerships with hospitals and also that impressive network of over 155 medical schools.
What about engaging new users?
What's really innovative is their engagement through dedicated education platforms for user onboarding. They offer unique try-before-buy trials. These have been highly effective, especially with novices, and have scaled their customer base to over 145,000 people.
Has it proven effective?
Clearly, it's driven 20% international growth and enabled great stories, like the medical school integrations, training thousands of future clinicians. Now, while this model supports scalability better than GE's more traditional, retail-heavy approach, the prevailing executive share disposal trends raise questions. Is it engaging enough customers fast enough to truly outpace GE's deeply established networks?
And finally, on the business model, how predictable are the revenue streams? Is it steady or volatile?
About 20% of the revenue is recurring. That comes from subscriptions and contracts for AI tools, educational platforms, things like that.
But the majority is still hardware.
Right, the vast majority, 80%, still depends on hardware sales, which can be more variable month to month, quarter to quarter. To mitigate this, they rely on longer-term hospital deals, which help stabilize about 40% of the revenue. We saw this play out in Q1's 20% growth, which occurred despite the company still operating at a loss.
So there's variability, but they have a cash buffer.
Yes, that variability impacts overall stability. But their $175 million in cash provides a crucial buffer for current burn rates. Compared to GE's highly predictable, often multi-year service contracts, this company's revenue variability definitely heightens the risk profile. And the executive share disposals could indicate a low level of internal confidence that they'll achieve full revenue predictability anytime soon.
Okay, we've dissected how they operate and what makes them unique. But now, the crucial part. How do they stack up against GE in a direct fight? Let's move to the competitive advantages, the strategic strengths that will really determine their potential against GE Healthcare. GE is the Goliath here, commanding 38% of the global ultrasound market. What strategic defenses does this company have?
Assessing these strengths is absolutely pivotal. GE's market share translates to billions in annual revenue from comprehensive high-end systems. They back that up with over $1 billion yearly in R&D and a vast global service network. It's formidable.
And this company's carving out a niche.
Exactly. In the rapidly growing point-of-care ultrasound, or POCUS, segment, that was valued at $3.24 billion in 2022, and it's projected to grow significantly, driven by demand for portability and affordability in all sorts of settings.
And this is where executive sentiment becomes a critical lens.
It really does. Recent net selling by key executives, like the CEO sale back in April 2025, forces us to ask, if these advantages are truly defensible, truly robust, why the hesitation from those who know the company best? Let's break down each element.
First up, do they have any kind of monopoly, even a small one, in their niche?
They don't command a full monopoly, no, but they definitely show near monopolistic traits within that specific handheld POCUS subcategory.
How so?
Well, they only capture about 0.16% of the total $9.3 billion ultrasound market. They are the leader in innovative chip-based devices. That position is fortified by over 500 patents and patent applications worldwide covering their core ultrasound-on-chip tech.
Which is hard to replicate.
Incredibly complex,
Yeah.
integrating thousands of microelectromechanical systems, MEMS, onto a single semiconductor, perfected over years by Rothberg. Regulatory advantages also help protect this, with broad clearances for whole-body imaging that competitors struggle to match. So while GE dominates traditional ultrasound with its 38%, this company's sharp focus on affordability, $2,000 probes versus GE's 50,000-plus systems drove that 20% revenue growth in Q1 2025. They're gaining ground in medical education, global health initiatives like in Kenya.
So these traits deter copycats.
They do. It protects profitability. But compared to GE's near-monopolistic grip on hospital contracts, those sticky multi-year deals, this company's moat feels more like, let's say, a drawbridge than an impregnable wall.
A drawbridge, not a wall. And the insider selling might reflect that view.
It could. That pattern of executive share disposals, including director stock awards in June 2025, not matched by buys, might indicate an internal awareness. An awareness that GE's powerful lobbying and sheer market inertia could prevent them from scaling to true monopolistic levels. It tempers the disruption narrative.
How about economies of scale? That's usually a massive advantage for incumbents like GE. Can this company compete there?
They are starting to benefit from economies of scale, especially in chip production. Their partnership with TSMC allows for unit cost reductions of 10–20% year over year as volumes increase. We see that reflected in gross margins climbing to 63% in Q1 2025.
Like smartphone manufacturing.
It's a similar dynamic. Leveraging semiconductor scale lets them price aggressively, undercutting GE's V-Scan handheld line, which costs 2 to 3 times more. It also improves efficiency for software updates that don't need hardware overhauls. Producing the IQ3 probe, for example, higher output led directly to lower assembly costs, enabling broader distribution to those 145,000 users. Compared to smaller rivals, their scale edge is clear.
But GE's scale is just on another level.
Completely different league. GE produces millions of units annually across integrated factories. That yields unbeatable cost advantages in service, parts. Their economies allow for 15% profit margins versus this company's ongoing losses. GE's scale, built over decades, is a formidable barrier.
And the CEO selling shares around the time of a capital raise.
Yes, the CEO's April 2025 sale, coinciding with that $82 million raise, is quite telling. It could signal that these scale benefits just aren't materializing fast enough to bridge that huge gap with GE, whose established economies effectively guard against price wars.
Network effects are so powerful today. Does that apply here? Does the product get better as more people use it?
Absolutely. The company's platform truly thrives on network effects. The value dramatically escalates as more users join.
How does that work in practice?
With over 145,000 clinicians contributing scan data anonymized, of course, to their Butterfly Garden AI ecosystem, which has 23 partners as of Q1 2025, the algorithms improved dramatically. Think of it like a medical Waze. Crowdsourced data constantly refines real-time guidance like that auto beeline feature for lungs.
And user growth directly improves the tech.
Directly. That 20% increase in active users in 2024 led to 30% faster AI processing times. It creates this virtuous cycle that locks in medical schools over 155 partnerships now and hospitals. There's a compelling case study from U.S. emergency departments showing that network-enabled training reportedly cut diagnostic errors by up to 25% in pilot programs. That fosters a stickiness GE's standalone hardware just can't replicate.
It is a strong advantage. But I assume GE isn't ignoring AI.
Definitely not. GE counters with its own AI integrations through its Edison platform, and they leverage a much, much larger installed base, over 500,000 systems worldwide.
So the insider selling might reflect doubts about catching up.
It could. The trend, with no significant buys amidst this growth, might reflect internal doubts. Doubts that this company's network can snowball fast enough to truly overtake GE's established ecosystem, especially in those highly regulated hospital environments where switching inertia is incredibly high.
How does the company strategically position itself against GE? Are they meeting them head-on or carving a different path?
They masterfully counterposition themselves. They are the democratizer of ultrasound. Portable, AI-empowered, accessible for non-specialists. They offer something GE can't easily replicate without cannibalizing its own high-margin premium lineup.
What are some specific strategies?
Things like education-focused bundles that train novices effectively. We see that with their 360-degree education platform, which has onboarded thousands in low-resource settings. That directly contrasts GE's specialist-oriented systems. The market response shows it works. That 35% revenue surge in Q4 2024 came from IQ3 adoptions in emerging markets where GE's bulkier tech struggles.
The COVID example was powerful, too.
Right. During the pandemic, their devices enabled remote diagnostics in overwhelmed ICUs. That was a critical pivot GE struggled with because of its legacy designs.
But GE is adapting with its own handhelds.
Yes, GE's vScan Air mimics some portability. And that pattern of executive caution, those April-May 2025 sales, suggests this counter-positioning might not be entirely unassailable. GE is investing heavily in miniaturization to defend its turf.
What about customer stickiness? Once a clinic or doctor adopts their system, how hard is it to switch away? Are there high switching costs?
There are indeed significant switching costs that lock customers in. Once clinicians get trained on this company's intuitive AI ecosystem using MSK VUE for guided scans, for example, they face real barriers, both emotional and logical, to switching.
Like retraining time.
Exactly. Relearning GE's more complex interfaces could cost hours per user. Plus, there's the financial hit of discarding $2,000 probes. The data backs this up. They show an 80% retention rate in medical school programs where the curriculum integrates their technology.
So it creates a moat, like software.
It mirrors software like Adobe in that way. But arguably, GE switching costs are even higher, often baked into those long-term multi-year contracts with big hospital systems. The executive share disposals might imply that this company's switching costs aren't yet deep enough or broad enough to stop GE from poaching enterprise clients, especially those already heavily invested in GE infrastructure.
How strong is their brand? Can it really compete with a household name like GE in the medical world?
Their brand strength is rooted in a very specific image. The trusted innovator focused on global health equity. It's powerfully built through stories like founder Rothberg's personal drive stemming from his child's illness.
That creates an emotional connection.
It does. Empowering frontline workers in places like Africa fosters deep loyalty, and it grants them emerging pricing power. Prices have held steady even amid inflation. Now, GE's brand is synonymous with clinical reliability. It dominates the traditional market. But this company's brand, focused on access and innovation, could incrementally erode GE's over time.
But the lack of insider buying raises questions.
It does. Can branding alone sustain momentum against GE's massive marketing muscle and deeply entrenched reputation? The lack of strong buying signals from insiders makes you wonder.
Does the company possess any unique, cornered resources, things competitors just can't access?
Yes, they corner several proprietary resources. Their core ultrasound-on-chip patents are key. And critically, founder Jonathan Rothberg acts as a remarkable talent magnet.
Attracting top engineers.
Yes, drawing top engineers from places like MIT and Stanford. They've outpaced peers in AI hires, doubling their AI team in 2024. Strategic partnerships, too, those 23 AI firms. Exclusive deals with TSMC for chip manufacturing, secure, hard-to-replicate infrastructure.
How does that compare to GE's resources?
Well, GE corners vast amounts of data from its huge installed base, but this company's agility helps it attract top talent more effectively in a startup environment. Still, the executive selling trends suggest that even these unique resources might not yet be sufficient for battles on GE's massive scale.
Are there unique process powers, ways they operate differently that give them an edge?
Absolutely. They've developed unique processes, refined over a decade. Think AI-driven workflows that cut scan times by 30% and significantly reduce error rates via real-time feedback.
Hard for others to copy.
Very difficult. You see it in competitors' slower iteration cycles. It provides a distinct quality edge similar perhaps to Toyota's lean manufacturing, boosting efficiency. GE's processes are robust, no doubt, but generally less agile and adaptable to rapid changes.
And the core technology itself, fundamentally better.
For portability and cost, yes, it's fundamentally superior. Using chips versus GE's piezoelectric crystals makes it roughly 10 times better on those specific aspects. And the integrated AI enables novice use effectively. Aiming for home care by 2026, that's truly disruptive potential. GE's tech excels in high-end precision, but lags significantly in accessibility and affordability.
Yeah.
That's the key difference.
Was their timing strategic when they launched?
Incredibly strategic. They timed the rise of the POC US wave perfectly, especially post-COVID. Launching their IQ device right amid the telehealth boom gave them a crucial first-mover advantage in chip-based ultrasound tech. Unlike GE's later, more reactive pivots with its V-Skin line, that early entry established a strong foothold.
How quickly can they execute? Roll out innovations faster than GE?
Their agility really shines here. Rapid launches, like the IQ3 in 2024, with twice the processing speed, optimizing supply chains for quick AI updates that actively discourages GE from making huge aggressive shifts into handhelds.
Faster global rollouts?
Yes, instances include global rollouts within months of regulatory clearance. That contrasts sharply with GE's typically longer multi-year timelines. However, again, the pattern of executive share disposals might signal that even this impressive execution speed isn't quite outpacing GE's immense resources and market penetration power.
How sustainable are these advantages long-term? Can they hold this edge?
Analysts project these strengths. The patents, network effects, core tech are sustainable for perhaps 5 to 10 years, assuming, and this is a big assumption, they achieve profitability by 2027. Long-term, the AI integrations could be particularly enduring, but sustainability really hinges on effectively fending off GE's competitive efforts.
And what are the main risks of these advantages eroding? What could trip them up?
There are significant risks. New entrants like Exo, who've raised $220 million, could potentially copy the portable devices. Intensifying competition, broader technological shifts are a threat too, maybe towards AI-only diagnostics that bypass hardware, or GE strategically acquiring smaller innovators.
External factors too.
Absolutely. Regulatory changes loom large. Supply chain disruptions, especially concerning those critical Taiwan chips, are a constant worry, and that consistent pattern of executive share disposals just amplifies these risks. It hints that these strategic advantages might erode before the company can truly challenge GE's long-standing dominance.
Let's shift focus now to the path forward. The company's growth strategy and its overall resilience in this dynamic market. What's the plan?
Their growth strategy is clear and multifaceted. It involves aggressive penetration with the IQ3 in U.S. hospitals. That's where they saw 24% growth. Concurrently, market development in high-potential regions like Africa and Asia, they hit 20% international growth there.
And continued product development.
Yes, continuous product development with AI enhancements via those 22 partners. And strategic diversification into the burgeoning home care segment. This growth is driven by crucial expansions into medical schools too, with over 155 partnerships now.
But the insider selling still casts a shadow.
It does. It flags persistent execution doubts when you view it against GE's formidable established market presence.
So what's the overall growth potential here? Is the ceiling high?
Opportunities truly abound. Particularly in new markets, Asia represents a $20 billion total addressable market they're actively targeting. Combine that with new AI launches, potential M&A for software capabilities, the growth runway looks long.
But GE is a huge hurdle.
A massive hurdle. While their past pivots show success, GE's sheer scale poses significant threats. And the executive caution we've noted underscores the inherent challenges in actually capitalizing on all this potential.
Can you put that market opportunity into perspective again, the TAM figures?
The overall ultrasound market is projected to hit $80 billion by 2026. This company specifically targets the $8 billion POC US segment, which itself is growing at a healthy 9% compound annual rate.
And their target share within that?
They're strategically positioned to capture maybe 20% of the handheld segment by 2030, primarily due to affordability. But it's crucial to remember their current overall market share is still quite small compared to GE.
How broad are the applications for their tech? Is it very niche or wide-ranging?
Incredibly broad, spanning obstetrics, musculoskeletal, cardiopulmonary assessments, even across industries like veterinary medicine and education. This wide applicability implies very high scalability and reach, extending far beyond GE's typically more specialized niches.
What about supply chain diversity, given global tensions? How exposed are they?
They rely significantly on Taiwan for those critical chips. That makes them particularly vulnerable to any escalating trade tensions. While they have mitigation efforts through partners, their supply chain is notably less diverse and more concentrated than GE's. That's an ongoing risk.
How diverse is the customer base? Relying on a few big clients.
It's impressively broad. Medical schools, hospitals, diverse global demographics. That diversity is further stabilized by their strong 20% international growth. It provides a wider spread of risk compared to relying on just a few large contracts.
What's the longevity outlook for the products themselves? Will they still be needed in 10 years?
There's roughly a 70% probability their products will endure and remain relevant long term. This is driven by powerful trends like aging populations and the rise of telehealth. Critically, their products are resilient in downturns because they offer cost savings. They capitalize on POCUS trends. Essential healthcare persists, unlike luxury medical equipment, making their solutions less vulnerable to economic cycles.
So main growth drivers and primary risks. Quick summary.
Key growth drivers: AI integrations, securing more hospital deals, and aggressive expansion into emerging markets. Main risks: GE's market saturation, the company's own persistent financial losses, and potential supply chain issues, especially chips.
Let's zoom out further. The macroeconomic landscape. How do big picture trends affect them?
Well, rising interest rates definitely put pressure on R&D borrowing, given their roughly $50 million in debt. But their $175 million cash reserve provides a crucial buffer. Potential rate cuts in 2025 could ease this pressure significantly, especially compared to GE's much larger leverage.
Trade tensions are a big factor.
A substantial concern. They can significantly disrupt the supply of those Asian chips, hindering expansion. While expansion into regions like Africa mitigates some risk by diversifying markets, GE's supply chains are just far superior in reach and resilience.
And inflation.
Inflation continues to squeeze margins, contributing to that negative 150% net margin.
Yeah.
However, their AI-driven pricing strategies are helping counter some of this. Importantly, underlying demand for healthcare services remains remarkably stable.
Any company-specific macro factors.
Healthcare spending trends broadly favor POCUS due to cost efficiencies. Regulatory clarity on AI from the FDA could accelerate approvals, aiding their competition with GE. However, the combined hit of inflation and trade issues continues to impact operations. And again, the executive share disposals might indeed reflect these broader macroeconomic headwinds within that intense competitive fight against GE.
Okay, let's dive into the numbers. We need to scrutinize the fuel gauge in this race against GE, the recent financial performance. And remember, we've seen executives, CEO and CFO included, being net sellers recently, over $900,000 in shares sold in April and May 2025, around $2.44 a share. This happened even as the company reported growth milestones. So if the numbers are improving, why the personal exits?
It's a key question. The Q1 2025 results, released May 2nd, paint that picture we discussed. Steady top-line momentum, but persistent bottom-line challenges. Pretty typical for a company like this in capital-intensive medtech.
What was the revenue figure again?
Revenue hit $21.2 million. That's up 20% year over year from $17.7 million in Q1 2024, and it actually beat consensus estimates. It marks their strongest first quarter ever. Driven by robust U.S. sales of $16.6 million, up 24% year over year, thanks to the IQ3 launch and expansion in medical schools, 155 partnerships now, and hospitals.
So strong demand signal, but dwarfed by GE.
Absolutely. The growth signals product market fit in POCUS, but is a drop in the bucket compared to GE's billions. It highlights that scale gap executives might doubt they can close quickly.
And profitability, still negative.
Still negative. Gross margin improved nicely to 63%, up 4.8 percentage points year over year. That thanks to supply chain efficiencies, and higher margin software subscriptions are about 20% of revenue now.
But operating margins.
Still deep in the red. Operating margins at negative 150%, net margin similar, reflects a $25 million net loss for the quarter. Now, that is an improvement from $28 million year over year, so efficiency is improving. Operationally, they're maturing.
But R&D and SG&A still burning cash.
Exactly. R&D was $12 million, flat year over year. Selling, general, and administrative expenses were $28 million, down 3%. But they still burn significant cash, and that rule of 40% metric we talked about.
Growth plus profitability.
Right. With 20% growth and negative 150% operating margin, the rule of 40 number is an alarming negative 130%. Way below the 40% benchmark for healthy growth companies. It flags them as a high-risk growth story, pushing profitability further out and potentially fueling those executive sales as break-even is maybe eyed for 2027.
What about returns on capital, ROIC?
Deeply negative. ROIC is approximately negative 20%. That signals inefficient capital use for every dollar invested. They aren't generating a positive return yet. Coupled with the $50 million annual cash burn, it explains why they had to raise capital,
That $82 million equity raise in Q1?
which diluted shareholders. Slice the pie into more pieces to fund AI expansions. Return on equity, ROE, is similarly negative, around negative 15%, underscoring how losses continue to erode shareholder value. Compare that to GE's ROIC of around 10%. That shows mature efficiency this company just lacks right now. It might explain why insiders are hedging.
What's the cash position like?
Debt.
Cash stood at $175 million after the raise, up from $134 million at the end of 2024. Debt is relatively low, around $50 million. That yields a strong current ratio of 5x.
So they have runway.
That liquidity gives them about 2 years of runway at current burn rates, crucial for R&D amid rising rates. But dilution risks clearly loom. The cash hoard supports the chase against GE, but frequent pit stops for capital raises slow momentum, echoing that executive caution.
Book value, free cash flow.
Book value growth is modest, about 2% year over year to 90 cents per share. Equity builds via raises, but losses chip away. Free cash flow was negative $30 million, though that improved 10% year over year. That's operating cash burn minus about $5 million in capital expenditures. Looking at their specific metrics, units sold up 15% year over year, maybe 5,000 implied units. Subscriptions hit 20% of revenue, 23 AI partners. Gross margin strong at 63%. These highlight the unique dynamics. Hardware drives 80% of revenue, but software's 80% plus margins could eventually lead to profitability. Adjusted EBITDA loss also narrowed to negative $15 million from negative $20 million, a key efficiency gauge.
How do these financials stack up against competitors like Philips or GE?
They actually outperform on growth. That 20% beats the industry average of 10%, like Philips 5%, but they lag significantly on profitability. GE's 15% net margins and 10% ROIC dwarf this company's negative figures. And while peers like XO or Clarius also burn cash, they typically do it at smaller scales.
Market share and valuation comparisons.
Market share, they hold 0.16% versus GE's 38%, Philips 38%, but they lead in handheld POCS affordability. Valuation-wise, they trade at about 4.7 times enterprise value to forward sales. Peers around 6x, GE is around 3x, so it suggests they might be undervalued on growth potential, but perhaps overvalued if competition intensifies. Their strengths in innovation versus weaknesses in scale explain why executives might sell while publicly touting a strong foundation.
Looking back over recent years, what are the overarching financial trends? Is there a clear positive or negative direction?
Over the past few years, the trend has been consistent annual revenue growth, averaging around 25%. Margins have improved, moving from maybe negative 200% towards negative 150%, largely due to diligent cost controls, and free cash flow burn has narrowed by about 15% annually.
So signs of progress towards break-even.
These trends do suggest a potential path to break even, perhaps by 2027, if their AI initiatives scale effectively. That would significantly bolster their disruptive potential against GE. However, persistent dilution shares outstanding are up 20% since the public offering, coupled with ongoing losses, could stall this progress, which aligns with those bearish signals from executive share disposals. We'll be watching very closely for the continuation of these trends in the upcoming Q2 results.
Okay, as we get closer to answering the big question about what executive selling means for their ambition against GE, let's look at the very latest happenings. What's going on right now, and what's the public conversation? With Q1 beats but only sales, no buys, recent events could really sway confidence.
Recent events definitely highlight their push for credibility. On May 2nd, those Q1 results showed 20% growth margin gains. Crucially, they also reported progress on the EU ROHS exemption that's vital for avoiding lead bans on probes, absolutely critical for international sales, which make up about 22% of revenue.
Any AI milestones or awards?
Yes, AI partnerships expanded to 23, including integrations like dissects for workflow enhancements, directly impacting adoption. And the IQ3 received a prestigious pre-Galen award in June 2025. It was hailed as disruptive, which boosts sentiment amid these growing POCUS trends.
But the dilution caveat remains.
It does. Despite the positive news that $82 million equity raised diluted shares, it definitely raised eyebrows about their cash needs, even with $175 million already on hand.
What are the upcoming catalysts to watch?
Upcoming Q2 2025 earnings are due August 1st. Analysts expect revenue around $24 million, up 25% year over year, and a loss per share of negative 6 cents. You should watch for updates on home care initiatives and any new profitability guidance. Positive beats could counter the selling narrative, but misses would certainly amplify doubts versus GE.
Any external factors to keep an eye on?
Externally, regulatory rules for AI from the FDA could accelerate approvals, potentially aiding their competition with GE. Investors are also watching ongoing dilution risks and any potential M&A activity, particularly for software capabilities.
What's the general vibe out there about this company, particularly among individual investors? What are people saying online?
Online chatter, looking at social media around July 23, 2025, reveals a generally neutral to negative sentiment. It's largely dominated by profitability concerns and those executive share disposals. Any positives on growth get tempered by dilution fears.
Can you quantify that sentiment?
Roughly 60% of relevant posts express negative sentiment about financial health. About 30% are positive, focus on innovation, and 10% are neutral. Primary concerns are the losses investors noting it's still a long way from profitability, expressing no clear path to value. And that phrase comes up a lot. Executive sales screamed out.
What are investors prioritizing?
Monitoring the AI roadmap closely, questioning if the portable revolution versus GE is too slow, assessing their ability to capture the total addressable market effectively.
Any specific examples of posts?
Sure. One investor noted 20% Q1 growth temps, but MAC of 150% margins and CEO sales, a little red flag for GE fight. Another pointed out, founder's vision is solid, but dilution kills momentum. Watch AUG earnings closely. The overall narrative balances hope and disruption against frustration with the cash burn, mirroring the caution seen in the executive actions.
We're getting close now. This section sharpens the lens on what executive confidence, or lack thereof, with over $922,000 in net selling in Q2 2025, including the CEO's big sale in May, reveals about the company's real prospects in this protracted battle against GE Healthcare.
In GE, let's reiterate, over $20 billion in annual revenue, 38% ultrasound market share. It's a true Goliath. This company's portable, chip-based tech aims to disrupt that $80 billion TAM like a nimble David.
But valuation reflects confidence or lack of it?
Exactly. Valuation is more than just numbers. It's the market's vote on confidence. An executive action selling shares amidst 20% Q1 growth might signal overvaluation or hidden risks. We need to dissect the valuation methods and see if the stock is actually trading at a discount.
So what is the current stock price?
As of July 23, 2025, is trading around $1.89 per share.
How does that compare historically?
It reflects about a 10% decline year-to-date from early 2025 highs, around $2.10. This is happening amid broader medtech volatility driven by rising rates and more scrutiny on healthcare spending. The price is hovering near 52-week lows, sharply down from those post-public offering peaks above $15 back in 2021.
Underscoring dilution and profitability delays.
Precisely. The steep decline underscores both ongoing dilution. Shares outstanding are up 20% since the public offering via capital raises and persistent delays in hitting profitability. These factors amplify the red flags from the executive selling as they offload shares at levels implying limited near-term upside, especially compared to GE's stable $180+ share price.
How should individual investors think about the margin of safety here? What does that mean in this context?
The margin of safety is essentially the discount you get when buying a stock below its estimated intrinsic value. It acts as a crucial cushion. Protection against estimation errors, market downturns, or unforeseen risks like this company's supply chain vulnerabilities or GE suddenly retaliating harder.
It's like insurance for investors.
It is, ensuring that even if growth falters, losses are minimized. For this company, with negative earnings and cash burn, that margin needs to be wide, maybe 30% to 50% below fair value, to really offset the dilution risks and those signals of doubt from executives.
So is $1.89 offering that margin?
It might offer it if you believe the intrinsic value is $3 or more. But GE's potential to erode their competitive advantages narrows that margin significantly, which helps explain why cautious executives might choose to sell rather than hold for the long, uncertain fight ahead.
Why does valuation matter so much in a situation like this? It feels like more than just a number-crunching exercise.
Valuation is your compass as an investor. It determines if an asset is overpriced, underpriced, or fairly valued. That's crucial for making decisions amid significant uncertainty like this company's path to break even by 2027 versus GE's established profitability.
It guides decisions beyond just buying or selling.
Yes, it guides managers on capital allocation like this company's R&D spend. It helps all stakeholders assess long-term sustainability. Overvaluation invites short attacks. Undervaluation signals potential opportunity.
And it contextualizes the insider selling.
Exactly. With executive selling happening even after strong Q1 beats, valuation matters doubly. It helps you contextualize whether those sales reflect personal liquidity needs or genuine doubts about competing in a market where GE invests over $1 billion annually in R&D. That could potentially cap this company's $97 million 2025 revenue projection. For you, the individual investor, valuation is the essential edge against hype, ensuring your decisions align with improving fundamentals, like those 63% gross margins, especially amid the big AI shifts.
What are the key valuation methods we should consider here, and what story do they tell?
Valuing this company requires blending methods. It needs approaches suited to its growth stage medtech profile, unprofitable but scaling fast, with proprietary AI and chip tech. And you have to layer executive sentiment on top as a qualitative factor.
Like discounted cash flow.
Intrinsic methods like DCF, Project Future Free Cash Flows, those were negative $30 million in Q1 but are narrowing. If you discount those future flows at a high weighted average cost of capital, say 12–15% because of the risk, this method points to maybe $2–3 per share. That assumes 20% growth, break even by 2027, and a terminal 3% growth rate. It captures the long-term POCUS market potential, but heavily penalizes the cash burn. It aligns somewhat with the analyst's average target of $4.17, though that target seems more optimistic.
What about relative valuation, comparing it to peers?
Relative valuation uses multiples like enterprise value to sales. Their forward multiple is around 4.7x. Peers like EXO might be at 6x, while mature GEs at 3x. This suggests potential undervaluation based on growth, but also potential overvaluation if competition heats up. It's ideal for comparing against GE's mature multiples.
So a hybrid approach is best.
I think so. A hybrid DCF relative valuation approach works best here. Pure multiples ignore the losses, while DCF incorporates the execution risks signaled by the executives. Given that post-public offering devaluations hit similar firms hard, conservative assumptions are absolutely key to avoid over-optimism in this tough rivalry with GE.
Let's steelman both sides now. Build the strongest possible argument against this company. What's the bear case?
Okay, the strongest bear case argues this company faces insurmountable hurdles. Profitability, competition, making it a potential value trap despite the top-line growth. Institutional analysts highlight the fierce rivalry. GE with 38% share, aggressive new entrants like EXO raising big money, $220 million, both eroding competitive advantages with handheld pivots like GE's Vscan Air.
Cash burn and dilution are key parts of the bear case.
Absolutely. Cash reserves are dwindling. $175 million post-raise sounds good, but they burn maybe $50 million a quarter. That forces dilution a 10% share increase just in Q1. The negative ROIC, negative 20%, signals poor capital use, especially with rising rates squeezing R&D. Some analysts have neutral ratings, target prices around $2.50, citing regulatory delays, supply risks from Taiwan chips, things that could halt that 20% growth.
And the insider selling fuels this.
It amplifies it significantly. Executives like DeVivo and Get selling over $922,000 worth in Q2, even after positive earnings news. It implies internal doubts about sustaining growth against GE's billion-dollar R&D budget. Retail investors online echo this. Insider sales screamed out, can't beat GE's scale. Sentiments like losses mount, dilution kills dominate negative chatter. Combining institutional forecasts like a loss per share of negative 21 cents for 2025 with retail fears of shady selling paints a picture of a highly speculative bet potentially doomed by GE's retaliation and internal execution gap.
Okay, that's a compelling bear argument. Now flip it. What's the strongest bull case for this company? What gets investors excited?
The strongest bull case centers on the idea that their innovative technology revolution positions them for explosive market capture, ultimately outpacing GE's slower legacy systems. Institutional analysts laud the 20% Q1 growth, the AI expansions with 23 partners, the IQ3's impressive 24% U.S. sales surge. They project robust 25% revenue growth in 2026, hitting $122 million, driven by expansion into home care and emerging markets.
The core technology advantage is key here.
Absolutely. The chip-based competitive advantage, protected by those 500-plus patents, enables that tenfold increase in accessibility. You see the potential in the 63% gross margins in Q1. Some analysts have buy ratings, target prices around $4, highlighting improving earnings per share trends and framing the founder's vision as truly disruptive, similar to his DNA sequencing breakthroughs.
And retail bulls are focused on the disruption narrative.
Yes. Online, you see 30% positive sentiment celebrating the portable revolution and the founder's genius. A common theme is GE is too slow. Posts like "disrupting GE with IQ3" gain traction, especially after awards. These bulls often dismiss the executive selling as just personal liquidity needs, not a signal of doubt.
So the overall bull thesis.
It combines those institutional growth estimates with retail hope in an AI moat that is currently undervalued. It suggests a potential 2 to 3 times upside from current levels if execution aligns perfectly with the company's ambitious vision, potentially trumping GE's more sluggish adaptation.
So weighing both the bear and bull arguments, what's the most probable thesis here? And based on that, is the stock currently trading at a discount?
The most probable thesis, balancing everything, points towards a short-term bearish outlook. This is driven primarily by the ongoing losses, the persistent executive share disposals signaling doubt, and the dilution risk amid continued cash burn.
But potentially bullish long-term.
Potentially. This short-term bearishness could transition to a long-term bullish outlook if, and it's a significant if, profitability effectively materializes, perhaps by 2027.
Where does the insider signal point most strongly?
The executive actions strongly lean towards the bearish side currently. Net sales significantly outweighing any buys during a period of reported growth. That reflects the consensus caution seen in both public conversations and institutional analyses.
So at $1.89, is it a bargain or fairly priced for the risks?
At $1.89, the stock does trade at a discount to its estimated intrinsic value of maybe $2.50 to $3.0 under this probable short-term bearish thesis. That offers potential 30–50% upside if growth holds despite the risks. Now, compared to the more optimistic analyst average target of $4.17, it appears deeply undervalued, potentially offering over 120% upside.
But caution is warranted.
Significant caution. The bearish elements, especially the consistent executive selling and the formidable threat from GE, cannot be ignored. Buyers do get a margin of safety at this price, but only if they truly believe in that long-term bullish pivot. Otherwise, considering the risks, it might be fairly priced for the potential pitfalls ahead.
Which brings us to the heart of it all, decoding that executive confidence. What does it truly tell us about this company's ability to challenge GE Healthcare over time? We've seen these tantalizing glimpses of disruption, strong growth, strategic AI advantages, but they're always shattered by the consistent selling, the ongoing losses, and GE's massive scale.
Executive confidence, based on their actions, clearly signals low conviction in near-term success. The net selling in 2025, a CEO's $781,000 sale in May at 2.44, the CFO's $144,000 sale, even happening amidst those strong Q1 beats, strongly suggests executives are hedging their personal stakes.
They might see current traction as a peak.
It's possible they view current traction as a high point before hitting more significant hurdles. Maybe further dilution is needed. Or they anticipate heightened competition from GE or others. While executives collectively hold about 10% of the equity, their sales have outpaced buys by roughly 2 to 1 recently. That implies internal doubts about sustaining momentum against GE's vast resources. It echoes those individual investor fears that sales equal no faith.
So the big question, can this company actually take down GE in the next 5–10 years?
Take down GE? Unlikely. I'd put the probability at maybe 30%. This company excels at disrupting a specific payoff US niche. They hold 0.16% market share compared to GE's 38%. Their tech 10x more affordable chip-based enables powerful narratives like the training in Kenya saving lives where GE's $50,000 systems are impractical. That's real impact.
But GE isn't standing still.
Not at all. GE is adapting. Its vScan handheld sales are up 10% year over year. They're backed by over $1 billion in annual R&D and truly global supply chains. This company's projected $97 million in 2025 revenue just pales in comparison to GE's billions, and their low vertical integration exposes them to disruptions GE is far better equipped to handle.
So a more probable outcome.
In my assessment, this company is more likely to carve out a significant niche, maybe a 10–15% share specifically in the handheld ultrasound segment by 2030, if their AI initiatives scale effectively. But taking down GE entirely would likely require either a major acquisition by a larger player or a fundamental paradigm shift in healthcare delivery, something the executive's caution certainly doesn't suggest is imminent. GE's established market position and brand loyalty are likely to endure, even with powerful secular trends like telehealth working in this company's favor.
So pulling it all together, what's your ultimate takeaway for individual investors looking at this unique disruptive company? What should they watch for? How can they apply this?
From a fundamental perspective, their ultrasound-on-chip technology is genuinely superior for accessibility. A pocket-sized device versus a bulky cart, that's a huge difference. The truly undervalued asymmetric information, I think, lies in that AI data flywheel. Having 145,000 users continuously feeding algorithms that could potentially lead to 30% better diagnostics over time. That's a factor largely overlooked by the market right now.
And that could drive outperformance
If the home care segment truly booms, that's something GE, burdened by its legacy systems and business model, cannot easily replicate. For you, the individual investor, the edge lies in continuous monitoring. Watch those executive filings each quarter. If significant buying activity emerges, especially after the upcoming Q2 earnings on August 1st, that could signal a real turnaround in internal conviction.
What else should they track?
Track the growth of their AI partnerships. Are they hitting 30 plus by year end? That's a key leading indicator compared to GE's slower integrations. And perhaps consider buying on significant dips, maybe below $1.50, for a potential 2x return, if and only if execution truly starts to align with the founder's ambitious disruptive vision.
This has been a truly insightful exploration into such a complex and competitive field. It really underscores how understanding those subtle signals from within a company, like executive share transactions, can be just as crucial as the big headlines. What truly stands out to you from our discussion today, and how does it shape your view on this intersection of innovation and market reality?
Love this? Drop a like, subscribe, and ring the bell so you never miss a podcast.